Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two co-hosts, Ryan Sweet. Hi, Ryan. How are you?
I'm good. I'm down at the beach, so
Yeah.
no
You look like
complaints.
you look like a beach bum.
Yeah, my whole family, we're all beach bums. We could stay on the beach for weeks.
How long did it take you to grow that beard?
Uh, uh, since vacation started,
Yeah, it
so
looks
it's been like
good.
a
The
week and a
old
half.
man in the sea, I must say though, you look,
Yeah,
you look like you've been out, pretty weathered there, out on in the ocean there, looking for marlin or something.
well, I'm chasing my three kids around. It's not really
Oh,
relaxing. We can't. My wife and I can't just sit on the beach and take a nap. We gotta chase them and make sure they don't go too far out in the ocean.
yeah, I forgot about those days. Yeah, and that was Chris Dorides. Chris was chuckling. Hey, Chris,
Yes. Hi, Mark.
and you're in the office
I
safely.
I am in the office.
Any more folks showing up, or is it still pretty spurting there?
Quite sparse. I think we have
Uh,
3 people on my floor today. So
Goodness. Remote work is live and well at Moody's Analytics. That's for
So to
sure.
give you an idea, there's one more person in Westchester on Chris's floor than there are people in Ocean City, New Jersey. So Dante, he's right behind. He's a couple streets
Oh,
behind us.
oh,
oh, you're saying colleagues?
Yeah,
Our colleagues, they're all there.
I
Everybody's
see.
we're
there.
all down in Ocean City.
Oh my gosh. So who's doing the work? Is that me? Chris
Th-
and I are doing the work.
They're
I did.
remote. They are
They're remote.
Yeah, I
Okay.
still
didn't say I'm not
publishing.
working.
Yeah. Good point. You're on this podcast. Yeah. Well, this is a special podcast, a little bit different than the others. We're going to focus on a topic. The topic at hand is stagflation, high inflation, and high unemployment. We'll come back to the definition of that. This has been top of mind uh, here in the U.S. and really all over the world. Inflation is high most everywhere because of the shocks created by the pandemic and the Russian invasion of Ukraine. And while we've been kind of downplaying the risks that we actually get into a stagflation scenario, we are getting lots and lots of questions from you, dear listeners. And so we thought we'd kind of do a deeper dive here and talk about stagflation in a more rigorous way. And that's the purpose of today's conversation. So it's about stagflation. And the first thing I think we need to do is define it. Define stagflation. That's a kind of a slippery concept. Hey guys, should I take a crack at that? Would you be okay with that if I kind of put my sort of straw man definition out there and you can kind of run with it? Does that sound
Yeah,
okay?
Sounds good.
go for
Okay.
it.
All right. Okay. Well, in my mind, there are three necessary and sufficient conditions for stagflation. First, high inflation. And high inflation, I would say, is an inflation rate, underlying inflation rate, that is more than a percentage point above the Federal Reserve's target. So let's just use CPI, consumer price inflation, as our benchmark. I would put the top end of the target, the Fed's target, at about 2.5%. So, first condition for stagflation is inflation that is consistently above 3.5%, a full point above the Fed's target range. Second, high unemployment. And here, I would say that would mean an unemployment rate that is more than a percentage point above our estimate of the unemployment rate consistent with full employment. Right now, I'd put that at about 3.5%. That's current unemployment. Some would put it higher. I think the Fed would put it at 4%. But let's say high unemployment would be anything above 4.5%. Probably closer to 5 in the current context. So inflation above CPI, inflation above 3.5, and unemployment above 4.5, uh, probably closer to 5. And then the third criteria would be um, it, you need high unemployment, high inflation for a period of time, not a month or two, or not even just for a few months. It's got to be a while. So I'd say certainly no less than 6 months, probably closer to 9, 12 months before I'd say, okay, we're in an environment of persistently high unemployment, persistently high inflation, and That's the definition I would use. I mean, you could kind of combine the high unemployment, high inflation to something called what has historically been called the misery index. That's just simply take the inflation rate, add the unemployment rate, and the two of those two things are called the misery index for obvious reasons. I mean, if you have high inflation, high unemployment, it's a miserable economic environment to be in. People don't feel very good about how things are going. And if you use that, that would say, by my definition, you'd need a misery index of 2.5% plus 4.5%. That would be 7%. That feels low. I mean, I kind of want to say the misery index has to be double digit, but not necessarily. I mean, if I told you we were at 3.5% inflation and a 5% unemployment rate between now and the end of 2023, that feels like stagflation to me. At least some variation of the theme. So that's the definition. So okay, so the three criteria: persistently high unemployment above the full employment unemployment rate, persistently high inflation above the Fed's target range, and persistent is the key word here. It's got to be at least 6 months, probably closer to a year before you call it stagflation. What do you think as a working definition of stagflation? Cris?
Yeah, I think that you hit on all the factors. And I think you also hit on the fact that duration matters a lot, right? It's not just a temporary blip that we're talking about. It's something that is persistent. And that there are shades of gray here, right? It's one thing if unemployment or inflation is just over 2% or closer to 3%, right? In addition to that, I would say the trend matters, right? If things are moving along but they're slowly improving, right? That's a different situation than if things are moving the opposite direction. So I think as a framework, it makes sense. And then the degree to which we worry depends on the specifics about the duration and the trajectory that we're under.
And I guess you kind of implicitly made a good point in as there's no arbiter of how to define stagflation. I mean, we've been debating recession here for weeks, months, and there is we've all agreed, I think most of us agreed, we have a final arbiter on recession. That's the Business Cycle Dating Committee, a group of academic economists at the National Bureau of Economic Research. But they're not going to sit there and say, oh, this is a stagflation. There's no one out there. In fact, what about us guys? The three of us should be the arbiters. What do you think of?
That works for me.
I like it.
Yeah, I like it too.
Yeah.
So your misery index right now is at 12.
Yeah. But I wouldn't call this stagflation, right?
Oh, I wouldn't call it either, because it's late 70s, early 80s when probably the last time we had stagflation was 22.
Yeah, but going back to my definition, it doesn't meet the criteria, right? Because unemployment is 3.5%. That's the full employment unemployment rate. So it's not, we don't have high unemployment. We're not even close.
You need both.
You need both.
Yes.
It's not
right.
Yeah.
High inflation. And the other thing I'd say is the inflation rate, it is elevated on CPI inflation. It's 8.5% through July year over year, but it feels like it's coming in here pretty fast, right? Mm-hmm. So that's the other thing. To Chris's point, the trajectory doesn't feel like stagflation if we continue on this deceleration path that we're seemingly on right now.
I'd say the misery index is a nice rule of thumb, but 1% increase in unemployment matters a whole lot more to consumers, households than 1% in inflation, I would argue. So
really, I don't know. That's a great question, though. Let me ask you that. So 1% unemployment, that means what? How many people does that represent? 1% of the labor force. The labor force is 150 million. That would be 1.5 million Americans who lost their jobs, right?
That's a recession.
That's a 1 percentage point increase in unemployment. It was 1.5 million people unemployed.
Yeah.
1% increase in inflation. That what is income? What's nominal income now? It's, I want to say, maybe you can look that up. I'm not sure.
I'm doing it right now.
Okay.
You want nominal?
Yeah, nominal income, total personal income. because I'm going to take 1% of that, and that's the loss of purchasing power, right? I mean, that's kind of how I would do it,
Yeah.
right? I'm going to
These are first order
I'd say
effects, right?
I say
And
personal income is $17 trillion. I'm just saying. I should get a cowbell if I'm right.
You're way off.
Oh, really?
21.7 billion.
Trillion?
Trillion.
Trey.
Yep.
Oh, because GDP is like 21 trillion, right? So income is this that
It
really
says
or
nominal personal income and outlays
really is 21 trillion. I
as of
guess
June.
so. I guess there's 1 trillion core. Okay, anyway, so 21. Okay, so 1% of that is 210 billion, right?
Billion. Yep.
That's a cowbell.
What's a cowboy? I
Doing
think
one
1% of
1%.
21
Yeah.
trillion.
Yeah.
Yeah, you
Maybe
got
it's
a
'cause
low
I'm on
bar.
vacation.
You got a
Yeah.
low bar. So it's the difference between 1.5 million unemployed Americans or a loss of $210 billion in purchasing power for all Americans.
Mhm.
And you're saying the 1 percentage point on unemployment feels worse than the 1 percentage point on inflation.
Mhm.
Okay. All right. That's an interesting question, though. I'm not sure, but fair enough. Fair enough.
Depends where you're at as well, of course, right? And
Yeah. Yeah,
moving
sure.
from, if you're at 19% inflation and you go to 20, right? Who
Right.
cares, right?
Oh my gosh, I don't even want to visualize that possibility. Yeah. But yeah, I hear you. Well, if we're
Well,
at
we're going to go
19%,
global in a moment here, right? So,
yeah, true. Good point. Uh, because the stagflation concern is not only here, it's everywhere. And, but before we go there,
yeah.
so are we all in agreement that, well, first let me ask you, Ryan, anything else you want to add to the definition of stagflation? The kind of the
No,
benchmarks I used?
I think you hit on all of it. I mean,
Okay.
do you think inflation expectations should be factored in? Like,
Well,
would they
that
have to
goes to the
become dislodged?
persistency. That goes to the persistency.
Okay.
So I think that's more a cause of,
Yeah.
I see. Yeah.
not something I would use to define stagflation.
Mhm.
But we'll come back to that because clearly inflation expectations matter a lot in
Yep.
terms of getting to stagflation. Okay, so we're all in agreement on that. And we're all in agreement that at the current point in time, we are not experiencing stagflation because unemployment is just too low. We're creating
Correct.
too many jobs, and unemployment's low. The inflation is painfully high, but the labor market's very strong. You would agree
Correct.
with that?
Mhm.
Yeah. Okay. All right. What about Europe? I mean, I guess the same thing at this point in time, right? Unemployment's still pretty low in most of those countries, even though recession seems more likely. But inflation is higher now in most of those countries, like the
Yeah.
UK. Yeah.
I would say
So,
some countries are already in stagflation, like in
oh, you
Estonia.
would?
Estonia with the double digit, I think 18, 19% inflation. And I think unemployment rate, probably 5, 6%.
Hey, Ryan, that deserves a cowbell. Estonia, really?
We talked about it
Yeah.
a couple podcasts ago. So
Did we?
I'm
I
going
don't.
off memory. So
Oh, is that right?
Estonia. Yeah.
Uh, yeah.
anyway,
And
I
that,
know it's elevated because of all the exposure to Russian gas that they
right,
have.
Mhm.
It's very acute there.
right,
So,
right.
and if you go a little beyond Europe, like Turkey, certainly. I think you
Right.
classified that as being in stagflation.
Right. I actually I don't know. I know the inflation rate's very high. I didn't realize is unemployment that high as well, well above its full employment unemployment rate. I didn't know that.
I believe so.
I
Oh,
believe
that's a
so.
good question.
Okay. Yeah. Okay. All right. So there are cases, small number in small countries, but there are some cases overseas that are, if they're not in stagflation, they're pretty close, even by our definition. And just to, if we're going cross country, it's important to point out that the full employment unemployment rate varies a lot from place to place, right? It's much higher in much of Europe compared to the United States. So a 3.5% unemployment rate in Europe would be well beyond full. They'd have blown past full employment. So, uh, but um, but there's differences there. Okay, let's then ask the question: what are the causes of stagflation? How do economies get into this mess? And of course, in the U.S., the last time we were in a stagflation environment, at least by our definition, that would have been in the 70s, second half of the 70s and the first half of the 1980s. Uh, what what is all the underlying causes of stagflation? Chris, you want to
Yeah,
tackle that?
sure. So I would say, broadly speaking, there are two causes. One is a supply shock, like the oil shocks that we experienced in the 70s, and the second is some type of policy error. And it's probably the combination of those that really enhances or leads to a truly miserable stagflation environment. That's what happened during the 70s in the U.S. Right? We had these supply shocks around oil, and at the same time, we had monetary policy errors in terms of the Fed easing when they should have been tightening. We had price controls on the fiscal side. You had some policies also that were certainly contributing to additional inflation. So wage and price controls, that certainly was problematic. What else happened? We had the gold standard, right? We transitioned off the gold standard, so depreciation of the dollar. So that transition period also likely contributed to the situation as well. Maybe as one-offs, each one of those might have been handled appropriately, but it really was that combination of all those factors that led to a particularly painful stagflationary environment.
Right. So maybe maybe you said it, but I'll provide more of a framework around it. But
Sure.
I think the first thing you said is a supply shock. So that's a hit to the supply side of the economy. And back in the 70s and 80s, that was primarily oil.
Yep.
OPEC oil embargo, the Iranian revolution. In the current context, that would be the Russian invasion of Ukraine, the higher oil and ag and commodity prices, and the pandemic. So there's some similarities there. The second you
Right.
said is a policy error. In you, I guess you're focusing on the Federal Reserve. They didn't see this back in the 70s and 80s. They didn't understand or see, because stagflation was not something that we had experienced. They didn't understand it. And they were trying to figure out, how do they respond to this supply shock? Do I raise interest rates to slow growth to combat the high inflation, or do I worry about the high unemployment and I ease lower interest rates to try to help the economy out and bring down unemployment? Two very different policy prescriptions, and obviously
Yeah.
they got it wrong.
Yeah.
They also
Stagflation
didn't.
wasn't even allowed in the model, right?
Right.
Wasn't even allowed in what?
in the original Keynesian models, right? There was no provision for stagflation. It wasn't possible under that framework.
Yeah,
Yeah, this
exactly.
trade-off, unemployment and
Yeah, good
inflation.
point. Yeah, you had that very
Phillips
clear
curve.
Phillips curve, so-called Phillips curve, right? Yeah. And I guess the one thing that contributed to that mistake was a complete misunderstanding or no understanding or even no thought of this concept of inflation expectation.
Yeah,
Right.
that's right.
And Ryan, do you want to explain that? Why that's what that is and why that's so important?
Why inflation expectations are so important?
Yeah, what
Like,
and how we think about that now.
there's a couple of ways that we kind of look at and measure inflation expectation. You can look at surveys of consumers. So, University of Michigan, for example, asked consumers what are their expectations for inflation, 1 year from now, 5 to 10 years from now. And what gets embedded in people's inflation expectations are the prices that they see on a daily basis. So it's gasoline prices, it's food prices. But the Fed also looks at market-based measures, inflation expectations. And I think the three of us pay way more attention to market-based measures because that's where the bond investors are putting their money where their mouth is. And why inflation expectations are important is that it gets embedded in people's behavior. Consumers alter their behavior depending on where they think inflation's headed. In the medium term, and businesses do the same. So that effectively will determine how people behave now is their expectations of where prices are headed down the road.
Yeah, and I guess in the 70s and 80s, there was not even a kind of a concept of inflation expectation. It was just I guess that concept was born out of that period. And people realized, oh my gosh, if inflation gets embedded in people's expectations about future inflation, it's much more likely that inflation will be realized and get kind of embedded, entrenched in the economy. And that Phillips, so-called Phillips curve, the relationship between, unemployment and inflation shifts. It kind of moves
Mhm.
out, because of the shift in inflation expectations.
And in the 70s and 80s, how would you measure market-based measures of
I don't think you could,
you
right?
didn't have
Even
tips, you didn't have treasury inflation protected securities back then. So
right. I guess you could have teased it out of the you could tease it out of the bond market. You could long-term
yeah,
interest rates, I guess. I think you could.
yeah, you could probably decompose the 10-year.
Yeah, 10-year
Yeah.
treasury yield into the constituent components
Mhm.
and kind of back out inflation
Yeah, the
expectations.
residual. Yeah.
But certainly no one was doing that at the time.
No, and it just
No,
wouldn't be as clear cut as using tips today.
Yeah.
they
And I
didn't
guess
have the
it's,
real time data, right?
Right.
Right. Or
it,
you'd be making a host of assumptions,
yeah,
right?
right. And I guess the other sort of concept that we now have a pretty good understanding of that was born in that period that's related to high inflation expectations is the kind of the wage price spiral, right?
Mhm.
So
Right.
if workers think inflation is going to be high in the future, they go to their employer and they say, look, my cost of living is rising quickly. I have to pay more to commute into work. I have to pay more for my clothing and to go to work for my to take care of my kids so I can come to work. You, Mister, Mrs. Employer, Miss Employer, you gotta pay me more to compensate for that. And then the business person says, oh, okay, Mister, Miss Worker, I'll pay you more because they think that inflation is going to be high, they can pass along their higher costs in
Right.
the form of higher prices. And you get into this kind of self reinforcing negative wage price, what we call spiral, wage price spiral. And that is all a result of these higher inflation expectations. And once you get into that dynamic, then you get into this kind of high inflation, unsustainable kind of economic environment where the economy starts falling apart and unemployment starts rising, and you got this very noxious combination of high inflation and high unemployment. But in the
Yeah. So
70s,
Mark, it's getting kind of expensive to drive in. It's getting expensive at the grocery store. Chris and I could use.
yeah, but your inflation expectations are well anchored, I
Oh,
would
they're
say.
anchored. Yep.
Yeah, they're well anchored. You know they're
Yeah.
coming back in.
Yeah, I know.
Yeah, yeah. So that doesn't work with me. That argument. Here's the third thing, though, I'd say. So, Chris, you said causes.
Yeah.
First, supply shock. Second, policy error, meaning
Both monetary and fiscal.
monetary and fiscal.
Yeah.
And on that front, going back to Europe, that feels like that could be an issue, right? I mean, in terms of monetary policy, both monetary and fiscal policy.
Mhm.
Yeah.
Right, we were talking about that today. Earlier, we had a meeting of international economists, and we're talking about particularly the UK. They're thinking about provide because they're Boris Johnson's out and somebody else is coming in, and that I guess the leading candidate wants to pass fiscal support to help with the cost of the higher energy costs that they're facing, and that's so-called fiscal stimulus, borrowing money to provide this uh, cash to households to navigate through. But that kind of runs counter to the policy prescription that you would think you would follow, because if inflation is high, you want to get inflation down, but they are kind of juicing the economy with this extra stimulus. It's understandable what they want to do. People are hurting and they don't want them to hurt. Particularly low income households have a big energy bills, particularly as winter approaches, and they want to help them. But the result of that may be it keeps inflation persistently high, exacerbates the inflation expectations, and it feels like the UK has a much greater risk of going into stagflation because of that policy.
Yeah.
Mhm.
Would you consider that a policy error then?
Yes.
Yeah.
You would. Okay.
There's also talk of price controls across
Mhm.
the continent as well, right?
Oh, I really,
I don't know that they're
Yeah.
certainly their party. There's a lot of elections going on.
Oh,
so
only you guys in
those games.
Italy, those guys, are probably it's the Italians that are thinking about
There's always some party in Italy that
some party. Yeah.
advocates for any old policy, but
Did price controls work in the 70s and 80s?
they did not.
I
They did
didn't.
not.
Yeah, I didn't think they worked.
Briefly, they just exacerbated the problem, right?
Yeah.
Mhm.
Yeah.
They work until they don't.
Well, here's the third factor I throw in, though, the third cause. And this is maybe a big difference between now and then in the 70s, 80s, is kind of some structural factors or forces, and maybe you mentioned this, in the economy that reinforce the wage price dynamic. So, for example, if you go back in the 70s, 80s, the economy was much more manufacturing based, construction based. It was highly unionized, but more importantly, a lot of the labor contracts had so-called cost of living adjustments, so-called COLAs. So they automatically had workers got automatic increases in their wages when inflation was high. So that served to reinforce this formation of this wage price spiral, and of course, which is at the heart of the stagflation scenario.
You see that
So
as a consequence of unionization?
no, well,
Or-
not necessarily. I think it was well intentioned, right? The work,
Yeah.
in a low inflation environment, you're saying, hey guys, you employer, you just got to compensate for me for inflation plus whatever productivity growth I get. So I don't think per se that's a bad thing, except if you get into this kind of stagflation environment with the supply shock, and then all of a sudden it's a turbocharger on this wage price spiral, and causes all kinds of problems. And so I think as a result of the experience of the 70s and 80s and the monetary policy response that to wring that out, a lot of those cola contracts got broken, and colas I think are, I don't know what share of contracts have those today, but I would imagine pretty small.
Not many.
And, I mean, the biggest one that comes to mind is the federal government.
Do they have cost of living adjustments
Mhm.
in those contracts? I didn't know
believe
that.
so.
Oh, really? Are you sure?
Because
Yeah.
no, I'm not 100% sure.
Yeah.
But whenever, I forget what month it is, you can calculate the COLA adjustment. And every January, the personal income report talks about the cost of living adjustment for federal workers. I don't know if it's everyone. It's just, I can pull it
Yeah.
up.
Well, Social Security
Yeah.
certainly
There you
So, yeah,
go.
has
that's
a
a big
big
one.
COLA. All right.
That's definitely the case.
So-
Yeah. Every Social Security recipient gets a 1 year bump related to last year's inflation rate. So
Mhm.
all the Social Security recipients this year are going to get a big increase, right? Because
Right.
based on the inflation rate as of, I think now, they're going to reset it pretty soon. Can't exact. I think it's August or something where they use that month to figure out what the cost of living adjustment is going to be. But that's a good point. Um, and I guess there's other structural differences between now and then. Uh, I, you know,
Well, we clearly aren't as dependent on oil or energy
right.
in as an economy. So,
That's a good
and
point.
certainly not as much on foreign oil, right? So,
Yeah.
there's
Right.
some insulating effect, which may be a reason why we haven't experienced an even worse situation given what's going on in energy markets.
Right. Okay. So, supply shock.
Yep.
Now, considering what's going on now and whether there's the fodder for or the groundwork for stagflation developing in the current environment, certainly supply shock. We got that right.
Mhm.
I mean,
More than one.
more than
Yeah,
one.
we got
So
plenty.
it feels even worse than what happened in the 70s and 80s, right? That was, well, of course, as
Well-
you say, oil was much more important back then. So maybe it's the same, roughly the same thing. But we've got the pandemic disrupting global supply chains and labor markets. That's a massive supply shock. Fading, but still, it's playing a big role. And second, the Russian invasion, that's higher oil, natural gas, agricultural, metals prices. So two massive shocks to the supply side of the economy. So we got that. This, I guess, there are big structural differences, right? It doesn't feel like we're in the same kind of league. So that would suggest stagflation would be less likely now than in the 70s and 80s. And that gets to the policy response. Here's, I suspect, is the big difference between now and then, right? Right. And Ryan, so do you want to talk about that? I mean, what is the appropriate policy response to an environment where stagflation might become, more of an issue?
Well, I thought you laid it out well earlier in that the Fed really doesn't have a playbook for stagflation. Stagflation. Central banks in general don't have playbooks for stagflation because it's their worst nightmare. Because how do they respond? Do they raise interest rates to slow the economy down to bring inflation back down closer to their target? But if they do that, then unemployment continues to rise. Or vice versa, do they cut interest rates to stimulate the economy to reduce unemployment, but then that would juice inflation higher? So the Fed's response in the 70s and 80s was just jack up interest rates as quickly as possible, as aggressively as possible, to wring out inflation. but that wasn't, that pushed us into a recession. So there's no, playbook for that. And that's why, later on when we talk about stagflation odds in the US, they're low because the Fed's facing Hobson's choice: either push the economy into a recession to avoid stagflation, or risk the economy eventually falling into a period of stagflation.
I guess in the 70s and 80s, the policy response was first in error. Because here's the thing, we probably should have said earlier, the the high inflation that developed in the late 70s and early 80s actually started all the way back in the 60s, right?
Yeah.
Because
Oh
we
yeah.
had, and in the 60s inflation coming into the 70s felt more like it was demand driven, right? You had a Vietnam War, you had the Great Society, you had a lot of government spending, expanding fiscal deficits and debt, and it pushed the economy past full employment, and wage and price pressure started to develop. Then you got into the 70s, and I think in 1973, you had the first oil embargo, and that caused oil prices to go skyward, and we were much more dependent on oil back then. And then another round of spikes in 1980. The Fed didn't really understand the dynamics here; it was more focused on the impact on the of these shocks on growth and high unemployment, accommodated with easier policy, trying to keep the economy moving and keep unemployment down. But that just exacerbated the inflation, and it got to a place so that by 1979, 1980, when Paul Volcker finally became Fed chair, we had, I think back then, 15% consumer price inflation, and unemployment was headed towards double digits. I mean, we closed in at 10% on the worst of it in the early 80s. And there was a massive change in policy, monetary policy at that point in time, where Paul Volcker said, "No, this is all wrong. We got to wring out inflation's our number one problem. We got to wring that out. And so I'm going to jack up interest rates, meaning we're going to have a doozy of a recession," and we did, to wring out those inflation expectations and bring inflation back in. And once we get inflation back in, then we can start worrying about the unemployment and trying to get out to the other side of the recession. So it was
wasn't
this
wasn't the Fed
massive mistake, and then Paul Volcker really brought the hammer down.
and wasn't the Fed less independent pre-Volcker?
I think that's fair to say.
Because you remember
Yeah,
reading all those reports and stories about the president trying to influence what the Fed was doing, and
yeah. I
yeah,
think that's
and
a
then
great
Volcker came
point.
in. Yeah,
So we say policy error, but it was, but
Yeah.
it doesn't go entirely to the Fed, right? It goes to the fact that the Fed was not independent or completely independent from the executive branch. The
right.
president, had influence over that. Certainly, I think Richard Nixon used his influence aggressively to try to keep interest rates down, and
hmm
obviously that exacerbated things. Um,
I
and
think it was
so,
the inconsistency of the policy as well, right? That was a lesson learned. Just first they tightened, then they loosened. It was just
yeah,
very confusing for businesses and consumers to understand what the policy was. And
Right.
Volcker, right, made it very clear: inflation's job one. This is what we're going to do. There was no ambiguity around it. I think that was also helpful in setting those expectations and
yeah.
getting us back on course. So.
Yeah, it's a good point. Good point. Throughout the 70s, the central banks couldn't quite figure, what do I worry about, the unemployment? Do I worry about the inflation? They kept swinging back and forth, and you got both high inflation and high unemployment. Nothing worked out.
Right.
Volcker said, "No, we're not doing any of that. I'm worried about inflation. I'm letting the economy go where it needs to go to get inflation back down." Yeah. And interestingly enough, it took a while to get inflation expectations all the way back down
Yeah.
to something the Fed would feel comfortable. I mean, Paul Volcker, I think he was chair of the Fed from 1979 to 1987, I think. And Greenspan followed in 1987. And he he didn't follow a similar policy. He called it a policy of opportunistic disinflation, right? Where, he didn't push the economy into recession like Volcker did. But he said, if the economy goes into recession, I'm not going to get it out very fast because I want to keep the unemployment rate high and make sure I wring out that wage price spiral and those inflation expectations. And it finally probably wasn't until, well into the 2000s, towards the end of Greenspan's term, that inflation finally came back settled in to where the Fed wanted them, their target. That I guess that's the other thing to point out. Back in the 70s and 80s, there was no inflation target, right? There was no explicit inflation target.
Mhm.
No one said 2%'s the number, right? It
No.
wasn't clear.
No, no, it wasn't until recently that they actually put pen to
Yeah, I
paper.
mean, recent meaning in the last couple of decades,
Yeah,
but
the last
yeah,
couple decades. Yeah,
yeah, right. So that I guess that's the other.
and there was no
Uh,
policy statement either.
yeah,
So markets just had to infer what the Fed was doing by what was going on in markets. So
yeah. You won't believe this, but when I first started, the Fed never announced what even the federal funds rate target was. You had to
right.
figure that out by
Hmm.
looking in the market, saying
Yep.
where is it trading. So they wouldn't announce anything. You had to, it was completely opaque. What they were doing.
It
So
wasn't
very, very.
until 1994 that they released their first statement, I think.
Is that right? Was it?
Yeah, I thought it
It
was
sounds about right.
1994.
Yeah, it sounds right. Yeah, under Greenspan. Yeah.
Hmm.
Okay, so thinking about the causes, then that gets to policy. So we've got the shocks, the supply shocks. Obviously, we've got that the high inflation. We don't have as the same problem structurally. I think we're in a better place there. But it really boils down to policy, and we learn from the policy mistakes of the 70s that it makes more sense for the Fed to, if inflation is high, wring out the inflation first, make sure that that's back at their target. Inflation and inflation expectations are back to their target, and then you worry about the
Hmm.
economy and where the economy is. And so that's kind of sort of where we are right now, right? And that means what that effectively means is the Fed is going to push us into recession sooner rather than they're not going to wait if inflation
Hmm.
remains high and accommodate it. They're going to fight it and wring it out. If that means recession, so be it. Get inflation back down. And then once you get inflation back down, then you start worrying about getting unemployment back down.
And that's what the Fed has basically been saying. That's what they're
It,
communicating is that we're
not,
going until
it's
we get
almost point
inflation back.
blank, right?
Yeah.
I mean, literally, they're telling you what they're going to do.
Hmm.
You go look at their forecast. They're saying, yeah, we're raising the funds rate 3.5 to 4%. In the next few meetings, we're going to wring this out. We're going to wring out this inflation.
Yep.
Right. Okay. And I get again that also goes back to Europe and some questions about whether the European Central Bank is going to be similarly predisposed to do that. I mean, because the Europeans before all of this had much lower inflation and much lower interest rates. I mean, they had up until a week or two ago, 3 weeks ago, they had negative interest rates. So, they're obviously now raising rates aggressively, but they're still incredibly low.
Hmm.
And it seems more likely that they would make a mistake, that they would be slower to raise rates to wring out that inflation and ensure we don't get into a stagflation scenario. What about on the fiscal policy side? Um, what would be a mistake there at this point?
Student loan forgiveness.
Yeah. Okay. So that the president announced that today, his student loan program, but there's a lot of cross currents in that, right?
Yeah. Yeah.
Yeah. I don't know that that has any bearing on growth or inflation. I mean, on the one, you have the debt forgiveness, all else being equal, that would juice growth and inflation, but then you also have the resumption of the payments. There was a moratorium on student loan payments during the pandemic. That is now going to come to an end. That would be a
Maybe.
restraint on growth and inflation. Well, maybe really. You think?
Well,
Oh,
they extended it again, right? So
oh, yeah,
who's to
It's
say?
never
yeah,
going to
yeah.
end.
Right. Good point. But don't you think at this point?
You well, I've been wrong before. So.
Yeah. Right. Right. Good point. Good point. If they don't, then you're right. It would be to cross purposes of the Fed. You know.
Hmm.
But if you let the moratorium expire and payments begin, then you do the arithmetic. It kind of washes out any impact on growth or inflation that you have on the debt forgiveness. Um, but
The magnitude is questionable, right? That I think that's really
small.
depends on the details.
Yeah.
All right. If things are extended out longer, how exactly the debt is forgiven. So
Yeah. Good point.
I think you're right. I think, theoretically, yes, there will be an impact. How big of an impact? really depends on
Yeah.
how this thing gets rolled out.
Yeah. But I guess you would, I mean, more broadly, you'd say any deficit finance fiscal support or stimulus would probably be a mistake, right? In the current environment.
Mhm.
Yep.
Yeah. I mean, and it feels like any proposal is now being looked, no matter what it is being looked at through the prism of what does it mean for inflation, like the Inflation Reduction Act. Although that doesn't significantly impact inflation in the near term, and obviously everything was looked at through that prism. You know, is it going to significantly? And in that case, it was not deficit financed. It was paid for, or
Mhm.
more than paid for. Yeah.
Everything except tax cuts, right? So
Everything so except tax cuts.
I don't think there would be much interest or discussion around at least from one side of the aisle, if we propose tax cuts at this point in terms of
Oh,
inflationary consequence. But
okay. Really? Yeah. You guys are
little
so
cynical.
cynical.
Little
My
cynical
gosh,
today.
you guys
Yeah.
are really cynical.
Yeah.
You're so cynical. It's over my head. It takes me a while to catch up to it.
Mhm.
Jeez Louise. I suppose you're right, though. I suppose you're right. Okay. So what are we concluding here then? Much less likely we're going to have a stagflation scenario here
In the
Okay.
US.
in the U.S. Okay.
Well, a severe stagflation scenario, right? Under your definition, if it's just
Yeah.
1% increase in inflation, 1% increase in unemployment,
Yeah.
I don't know if that's certainly not
Yeah.
very remote,
Yeah.
right? So
Yeah. It's not way out there on the tail
Yeah.
of possible
Mm.
outcomes.
yeah.
Yeah.
A 70s style stagflation scenario, which I think is what most people have in mind. I think that is pretty far out on the tail, given the Fed's resolve. But
Yeah. Well, that was like high single digit, double digit unemployment and double digit inflation. That
yeah,
feels like that's
that-
way out
That's
on the
yeah.
tail.
right.
Mhm.
Okay.
Because if you go back to our rule of thumb of using the misery index, it's at 12 now. That's what it was in 2011. And I don't think anyone would argue that we had stagflation in 2011.
No.
Say that again.
The misery index is
Yeah.
currently at the same level it was in 2011. And
I see. Because
no one was talking about stagflation in 2011.
Right. Because inflation was on the floor at that time.
Exactly.
Yeah. Right. Okay. And that goes back to my point. It's got to be high inflation, high unemployment.
Yeah, correct.
Yeah, okay. All right. So what indicators should we be looking at to gauge whether we're going down the stagflation path? What would you look at to gauge, if that scenario is coming to fruition?
I'd say the expectations are number one.
Yep.
Right.
Mhm.
Are they getting unanchored? Or are they coming in
Yep.
as a precursor of where things might be headed and how consumers and investors will change their behavior? Right.
And they're anchored.
Are they?
Market-based measures of inflation expectations. Have you looked at five-year forwards?
Well, have you looked at 1 year, 5 year forwards?
You're cherry picking. No, they're
I'm
fine.
not cherry picking. I was going to ask you, what is your number one favorite measure of inflation expectations? 5
I
year,
would-
5 year forwards?
I mean, that would be probably up top
For the long run, right?
For the long run. And
Okay, then
the other
that's inflation 5 years from now in the
5 years out.
subsequent 5 year period. So that's
Mhm.
way out there in the future, right?
Yeah, and I forget which regional.
And
Fed-
that one is anchored, right? I think
That
is
Ryan-
anchored.
I think
Oh, yeah.
Ryan's right. No one thinks
It's always been anchored, though.
Yeah,
It
I don't
never even
think-
came close to being unanchored, right? Okay,
one way or another we're gonna
get back
keep
there.
get inflation
Yeah.
down.
Yeah. Well, they're saying like us, there's no such. We're not going to have stagflation. That's not happening.
Correct.
Not
Right.
to that magnitude, no.
Yeah.
Right.
Okay. So, what is your favorite measure, Ryan?
5 year forwards. And
Oh,
then
it
also,
is. Okay.
I think,
All right.
is it I forget which regional Fed does it. They adjust 5 year forwards for like the liquidity premium. So it's a real measure of inflation expectations. So that's my number one.
All right. And okay. That's anchored. You're right. Chris,
Mhm.
what's yours?
I keep an eye on the 5-year break even just because it's readily available.
And explain what that is.
So that's the difference between the yield on a nominal 5-year treasury and a TIPS 5-year treasury, so an inflation protected.
Okay. And what's that
security.
right now?
I don't know what it is right now. I was about to look it up.
Yeah.
but
Quickly.
I got it.
last
Hold
I
on.
looked, it was cut. It certainly had come in, but
But it was on the high side, right?
it was
It's
not. Yeah,
2.77.
Okay. So that's high, right?
that is high.
It was
Higher
3.5
than
during earlier this year. It's come down.
At the
Yeah,
start
yeah.
of the, yeah. the
But
invasion, right?
it should be no more than, ideally, right? You want it 2.5, no more.
Right.
So we're
Or
20.
spitting distance.
Yeah, okay, fine. Fair enough. Fair enough.
3.5, I would be
Oh,
concerned
here's the
about.
other thing that gives me
Yeah.
some
Yeah.
solace on that, though, Chris. It's 5 years, right? So inflation in the first year is going to be high, right?
Sure.
So actually, it might actually be 2.5, right? So let's say in the first year, it's uh, high by 5 percentage points. It's 7.5% in the first year. Divide by five, right? Oh,
It's
actually,
coming in. Yeah.
even no less than that. If it's 5 percentage points over, divide by five, that's even less than that. What am I saying? If it's if it's I know no cowbell for me.
Yeah,
Okay, if it's
we're taking it
100,
back.
if it's 1.25 percentage points high in the first year, right, and you
Mhm.
divide by five, that's 25 basis points per annum, isn't it?
Right.
Yes.
So that's so that may actually be consistent with 2.5%.
Hmm.
To my point, 1 year, 5 year forwards, right? 1 year, 5 year forwards is 1 year from now. So forget about the next year because we know that by definition that's going to be high. And it's the 5 year period after that. And that is, last I looked, on the high side. If you look at the
Also high.
ICE measure,
Mhm.
the International Continental Exchange, they put together a measure based on break evens and also on inflation swaps, another way the bond market votes on inflation. And that's at yesterday that was at 2.8%. That made me
Yep.
a little nervous. It's up.
I mean, if you look at the inflation swap curve, so what's inflation, expectations over various time horizons, it's for the most part they're saying we're going to get inflation back in the next couple of years down to 2%.
Okay, fine. All right. In
So
fact, can you, I haven't looked at that swap curve. Can you just send me the link to something I can look at? Or is that off of
it's
our
off
friendly?
my computer. I'll send it to you
Okay, send it to me. Okay.
on Monday.
Yeah. 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 When you get back from your bum beach vacation.
Hmm.
Okay, you got it. Anything? What other measure? So it's only we're looking at inflation expectations. I get, I totally get that. And right now, we're debating it, but it feels sort of okay. Maybe a little bit on the high side, but within, as Ryan said, spitting distance of where we want it to be. So no big deal. What about wage growth?
Hmm.
Think we should be focused on wage growth? I mean, I think in the current context, probably, right?
Yeah,
Yep.
the employment cost index that's growing pretty quickly.
Yeah. What's the EC? You want to describe the ECI? I know we have
It's
in past podcasts, but
Yeah, the employment cost index is a measure of nominal wages in the U.S., but unlike average hourly earnings and other measures of wages, they can adjust for composition changes. So, average hourly earnings get skewed because if a lot of job growth in leisure and hospitality, lower paying industries, that's going to bias average hourly earnings one way, and vice versa. But the employment cost index adjusts for that. So that's why I think it's one of the best measures of wages, along with the Atlanta Fed wage tracker, because they
yeah,
kind of do a similar thing that the ECI does.
and they're both over 5% year over year,
Correct.
right? And by my calculation, what we'd want to see something closer to 3.5%.
Yeah, and so
That
one
would
thing
be,
I'm tracking, like when like kind of leads the ECI by a couple of months, is the quits rate. So when you have a very high quit rate, job switchers, they're typically getting higher pay increases, and that's going to juice wage growth. So the quit rate is still very, very high. So it doesn't look like nominal wage growth is going to moderate the next quarter or two.
oh, is that right?
Hmm.
That's interesting. Um,
That's how I forecast the ECI. Is one of the inputs is the quits rate.
is it show any kind of leveling off in growth, or is it going to show
Yeah. Oh,
continued?
yeah. So there's a little bit of leveling off, and then
Okay,
I expect the quits rate to come in,
right,
over the next year or so.
right, right. And I said 3.5% just for context. That would be 2% inflation plus 1.5% productivity growth. So if
Mhm.
that's 3.5%, if you're at 3.5%, workers are getting their share of the economic pie. And, that would be consistent with stable 2% inflation. And we're at 5%.
Mhm.
So I think really we should watch that ECI, the Employment Cost Index, the Atlanta Wage Tracker, hopefully we level off around 5 and start to come in. And
Mhm.
the quit rate is a good third indicator, if that's a good leading indicator, as you say, is a good leading indicator of wage growth, which sounds very intuitive. I hadn't looked at that, but that sounds interesting.
What about the beverage curve? So the
Yeah,
beverage curve is the
yeah,
relationship between job openings and the unemployment rate. So where we are, like right now, we have very high job opening rate and a very low unemployment rate. And that's what the Fed wants, is to bring that uh, job opening rate down, but without nudging the unemployment rate higher.
yeah,
How many of
So
those openings do you think are real?
yeah. Right.
that's a whole nother podcast.
Yeah. Right.
Important one.
Yeah.
Mhm.
I mean, we've got 10 million plus job openings. For context, before the pandemic, when the labor market was really tight, I think it was 7.5 million. So we're at 10. The peak was 11 million plus. So we're coming
Yeah.
down, but
Mhm.
we're still very elevated. And that doesn't give you a lot of confidence that wage growth is going to start to moderate here, get back to that 3.5%, except
No.
for what you just alluded to, and that is, do you really believe it's a hard 10 million job
Right.
openings? Like I would suspect companies, once they put up a job posting, are going to be pretty reluctant to take it down. What they do is they just slow boat any
Yeah.
hiring. You say, okay, let's keep the interview process going, sort of tell the candidate to come in a month from now. We'll kind of take our time and maybe we'll offer them something next year on the other side of whatever's happening now, that kind of thing. So I think we got to come up with a term. I think I call them soft openings, as opposed to hard job openings. That was the case a few months ago. But there's no way of, is there any good way of gauging that? I don't think so. I can't think of a good way. How real are those job openings?
Right.
Yeah, exactly. Okay, but that's a good one though. We probably should watch that too. So the JOLTS survey, job opening labor turnover survey, which has the job openings data, the quits rate, layoffs, that would be
Right.
good to watch. Okay.
What about Chris's
Anything
favorite, jobless claims?
and jobless claims? Yeah,
Mhm.
a window into layoffs, which
Yep.
again don't show any real meaningful erosion, at least not yet. Okay. What about? I say this with some intrepidation. Productivity growth. I mean, obviously, as I said, 3.5% is the bogey. That assumes 1.5% productivity growth. We certainly, if you believe the data, aren't getting that now, right? I mean, productivity is declining, at least over the
Right.
last year. Should we pay any attention to that, or is that just the measurement issues that are just too much to really use that measure in the near term?
It's a bit
Any
of a
views?
lag
I'm
measure.
skeptical.
Right? Oh,
Yeah.
what's
Yeah.
that? You're
I was
skeptical?
just going to say I'm skeptical because productivity is volatile, very volatile from quarter to quarter, even year to
Yeah.
year. So if we're trying to assess stagflation risk in the near term in the next 12, 18 months, I put productivity pretty low on my list.
Right. Okay. Yeah, I kind of agree with you. I mean, if it was a more accurate measure of reality, maybe, but it doesn't feel
Correct.
like it. Okay. Any other indicators you would kind of point to that might be helpful here? Any Ryan? Anything in the financial markets that think would be useful in
I mean,
this
of
regard?
course, oil prices, like different commodity
Yeah, going back to
prices.
the shocks.
Yeah,
Yeah, that's a great point though.
mhm,
You're right. I mean, a lot depends on what's happening with the supply shocks, right?
correct.
Yeah, I mean, if oil prices are rising, that means much more likely stagflation will become a problem. If the oil prices are falling or down,
Mhm.
not not so much or less so, and that's encouraging.
And then getting back to another one of Chris's causes, I mean, you could look at, the market implied path of the Fed funds rate.
Yeah,
So if that starts to really deviate from what the Feds is saying, then, I mean, right now they're anticipating the Fed cutting rates in late 2023. So basically they're saying the Fed's going to tame inflation and realize it did too much and then start normalizing and returning the Fed funds rate to its equilibrium rate.
yeah. Okay. All right. Well, let's wrap this up then, like we typically do, so that we make this more concrete. Let me ask you this: what do you think the odds are of a stagflation scenario developing over the next 12 to 18 months? And when I say that, kind of a minimum viable stagflation scenario, by my definition, 1% unemployment being a percentage point above full employment, at least 4.5, probably closer to 5. Inflation 1 point above the Fed's target on CPI, so let's say 3.5, maybe closer to 4. And that we have this in a persistent way. It's not. It feels like it's going to remain in place for throughout most of this period through 2023, the next 12 to 18 months. That's the stagflation scenario that I would say would be the minimum kind of criteria for being labeled a stagflation scenario. So what's the probability of that happening over the next 12 to 18 months? Cris, you want to go first?
Sure. So for the U.S., we're talking about here.
U.S. And then we can do Europe or UK
Europe
or
next.
Yeah.
I would say 10%.
10
for minimum viable.
Yeah.
That's not that high.
It's not that high. For me, I view the distribution as a bit more barbelled, if you will. Either the Fed is going to be really aggressive and just will go right into recession, right? Bring inflation down with it as an option, or not. We'll skate by. I don't know that we would have the conditions for a stagflation scenario building up, right? The Fed kind of easing back and indecisive. That I just don't put a lot of probability weight on that scenario rising.
Yeah. Okay. And Ryan, what probability would you put on that scenario?
Yeah, I'd be close to Cris, 10-15%, because I think the Fed's going to kill inflation.
Right. But by the way, can I ask, in that scenario, do we ultimately end up in recession?
Yes.
Yes. Yeah.
Yeah. Okay. Is that another feature of stagflation scenario that you ultimately end up in recession? Probably, right?
Yeah.
Yeah. I've always thought of it as recession plus. Right.
Right.
Is it? Well, you're saying you have to be in recession to get unemployment up that high? Not necessarily. Yeah. Oh, you think? Oh, maybe.
Well,
you're right.
okay. Then it goes
Yeah,
back to the gray zone, right?
Yeah, interesting.
Stagflationary.
Yeah. If I go up by a point on unemployment, that
That's a
feels like a
recession.
recession.
Right.
Well, remember, there's never been a recession when unemployment rate goes up by 30, 40 basis points on a 3-month moving average basis. So
Yeah.
you get 1 point, even if
Yeah.
you spread it out over several months,
Yeah.
that's a recession.
Yeah. I guess in a stagflation scenario, the recession just happens later rather than sooner,
Yes.
right? Because
Right.
to allow the inflation to develop and become more persistent.
Mhm.
Right. So it's not a typical recession, if there's such a thing. In the current context, that would be you go into recession fast. The Fed pushes us in fast to wring out the inflation. Whereas stagflation scenarios, they don't do that, and we kind of hang in this tough world of recession, but still very high inflation for a while. And then the Fed says, enough already.
Yep.
I got to wring this out. And they push us into recession. It just happens later.
Mhm.
Okay.
What are your odds?
About the same.
All right.
Yeah. I wouldn't argue. I might even put it a little lower. You said 10. Cris said 10. You said 10 to 15. I'd say 5 to 10, something like that.
Mhm.
I think the probabilities are pretty low.
So the fact that we all agree on something means we're going to have stagflation.
No, I know.
That's never good.
Well, the only reason I get to 5 to 10 is only to the point you made that the supply shock could reverse. It could get worse again,
Mhm.
right?
Yeah.
I mean, who's to say the pandemic doesn't come back around, right? Or who's to say something doesn't happen in oil markets or in the refinery industry that causes oil or gas prices to go skyward again? So given that there is some meaningful, I say 5 to 10 is meaningful, but I think the odds of a policy mistake, they're pretty close to nil. I just don't see that happening. Yeah. I mean, the Fed is on the warpath here, right? Anytime inflation expectations look like they're coming untethered, they're going to step on the brakes.
You mean a policy mistake to cause stagflation?
Well,
you can still have a
remember,
policy mistake.
yeah,
by going-
policy makes
yeah.
to cause it. I mean, this
Yeah.
goes back to the causes of stagflation,
Mhm.
right? It's the supply shock, it's the policy error, and it's the structural issues. I'm saying I can't see it. The structural issues are much less relevant unless there's something I'm missing. I just don't see it. I mean, there are structural forces that might result in higher rates of inflation than we're anticipating, like the backtracking on globalization, for example. That's, maybe the increase in globalization in the last decade really weighed on inflation. Now we're backtracking for lots of obvious reasons.
Right.
So maybe there are some structural things that I'm discounting, but I tend to think they're small. The thing that gets me to 5 to 10% is the shock, that the shock can come back around. It's not on the policy side. I think. But anyway.
What
All
do you
right.
think what do you think for Europe or Japan?
Oh, yeah, great point. Well, can we make a distinction between UK and the rest of Europe,
Yeah.
Eurozone? I say
I think they do.
UK. What do you say on UK, Chris? What's that?
I think they do. So.
Oh, yeah, they do. Yeah, can we do that, please? Yeah, exactly. Okay, what do you say on the UK and then on the Eurozone? This is to
Oh,
Chris.
substantially higher.
Yeah.
I'm trying to think where I would go. I'd
Yeah.
put it higher in the UK probably than the Eurozone,
Yeah.
and pretty high.
Over
They're
20.
all at 30-40%.
Oh, wow. That is high.
Because I do think that they're much more vulnerable to the shocks. Another shock.
Yes.
Okay. You too, Ryan?
Yeah.
30 to 40?
30 to 40. Yeah.
Yeah, no, I'm not that high. I'm closer to 20. Maybe 25 if you press me. And then on the Eurozone.
But you
I'd
came
say-
in at 10 until you heard the 30, right?
Yeah.
No. I wasn't at 10. I might have gone up from 15 to 20. I don't know.
How
Subconsciously.
about anchoring, right?
Yeah, that's not anchoring. You're pulling me northward. On the Eurozone, I say that's higher than the US, but lower than UK. So I'd say 10 to 15. So, 5 to 10 for the US, 10 to 15 for the Eurozone, say 20% ish for the UK, something like that. Yeah. All right.
What about like a Japan? I've heard people trying to figure that one out, right? That's
Wait, Japan has inflation?
what does that even
yeah.
mean, right? It's tough to.
Well, their target is
fathom.
2, and they just barely got above 2 with all of this mess.
Yeah, I think they're like 2
Yeah.
and
No, I'm not worried
2,
about
3,
stagflation
2, 4.
there.
But
Yeah, I think it's still a deflation worry, not a stagflation
Right.
worry. Okay. Anything else on this topic that we think is important that we missed? I think we covered a lot of ground.
Mhm.
I think I feel pretty good about it. Okay. Any last call? Anything else on stagflation? All right, very good. I think we're going to call this a podcast. And listener, if we did miss something, I just have this nagging feeling that there's something we missed that was big, but I can't think what it is. Let us know, and we'll come back around and address that. So with that, thank you very much, and we'll talk to you soon. Take care now. Oh, by the way, this is what I forgot to say. We run these scenarios across different countries all over the world, US, UK, Europe, not just the baseline scenario where everything kind of works out, not just a typical recession where we suffer kind of a downturn consistent with the average recession since World War II. But we also run stagflation scenarios. So if you're interested, let us know, and we can help you with that. So now, for real, thank you for listening in. Talk to you next week.